Hi everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we have with us Ervin, the CEO of Reality Shares. We talk about dividend growth, how to find companies that are going to raise their dividends, and also something called dividend swaps. So make sure to tune in for that right after this. All right, well, with us now we have Ervin, the CEO of Reality Shares. Eric, thanks for joining us.
Yeah, thanks for having me.
So, Eric, your company's funds focus on the idea of dividend growth. So I've seen companies out there focus on yields or dividend payers, but there are a few that take into account this idea of the growth of dividends. So why are you guys zeroing in on this aspect of the dividend world?
Yeah, it's a good point and a very, very interesting distinction. So we view dividend growth as really a window into the health of the company or business. If a company, for example, is paying a high yield, that doesn't necessarily mean it's a good quality business. If the company, though, on the flip side, is growing that dividend over time, then that's usually a sign of growing earnings and growing profitability in the company as a whole. So if you look back historically, Ned Davis has done a study where they break up the market into dividend payers, dividend growers, dividend cutters, and then non-dividend payers. And the dividend growers over that entire 45-year time frame have outperformed all the other categories by a wide margin, and meaningful extra compounding. And it's not magic. I don't think that there's, it's like a secret sauce. What it is it's just companies that can grow their earnings over time tend to outperform companies that don't. And the dividend growth is a reflection of that.
Okay. And do you find any particular sector biases with this sort of strategy, or is it more or less similar to what we see with the S&P 500?
It is very similar to the S&P 500, but there's times when, say, in the late 90s, when technology companies really didn't pay dividends at the time, and so would have been almost entirely excluded from a strategy like this. However, in 2001 and 2002, they would have also been excluded, which would have been a real significant outperformance. So you have different regimes where the industry as a whole isn't really able to grow its dividends or doesn't pay a dividend. It will be excluded from a strategy like that. And that, I think, is the essence of why the strategy does so well, is it's kind of avoiding those companies that can't or don't reward their shareholders with profit growth. And that's, I think, a really accurate reflection of this strategy. Now, this year, as an example, so you wouldn't see utilities, you really wouldn't see a whole lot of energy companies in a dividend growth style strategy because there just haven't been the opportunity to grow those profits and grow those dividends.
So what kind of companies are in this sort of strategy right now then, if it's not utilities or the other sectors that you mentioned?
You'll find, and again, maybe I'll make another distinction about why our strategy, because like you mentioned in the earlier part of the call, there are a number of different dividend growth strategies out there. Typically, the one distinction is that most of them are based on history. So, for example, the Dividend Aristocrats focuses on the companies that have been able to grow their dividend for 25 years in a row, or the Dividend Achievers Index 10 years in a row. So all those strategies work well, but we've found that there's a flaw in that they're not necessarily going to grow their dividends in the next 5 years or 25 years or 10 years just because they did in the past. So that's one. The other is that the dividend growth starts to taper off. Those are very mature businesses. If you've been able to grow your dividend for 25 years, you're probably not going to have as strong of dividend growth for the next 25 years. And so you really want to find those companies who have the ability to grow their dividends in the next period, the next 12 months. And that's kind of where the Reality Shares difference is the future dividend growth. So you find companies like Starbucks, Nike, but then other companies as well, like Tyson Foods. There's just a number of different kind of industries in that breakdown. Almost, nine sectors are fully represented. But the companies that can't grow their dividends, such as the energy or the utility companies, those tend to fall at the very bottom of the list in terms of dividend health right now.
Yeah, that's a good point. A lot of the other sort of dividend growth focused ones are, just really look at the history as opposed to the future. So how do you find companies that are likely to raise dividends in this next 12-month period?
Well, that was the real challenge that we set out to accomplish, was to figure out a model that was predictive in looking at future dividend growth. And there's no one factor that answers the question, but we thought you'd think that analyst estimates might be a good factor. And it's strong, but it's not strong enough. And basically what we did was we analyzed all these different factors and boiled it down to the 7 most influential factors that drive dividend growth. And they're things like dividend estimates from analysts, the free cash flow, as a relation to the dividend. So that's basically what you're thinking of there is your earnings or dividend payout ratio. But instead of using earnings, which is less predictive and less real, is to use the free cash flow. And that is really an indication of how much cash is available after you pay your debt to pay that dividend. So the free cash flow as a percentage of dividends. And then are companies buying back their stock as well as paying a dividend? Because if they are, and they fall onto hard times in the business, they can always cut back on that buyback program because it's more of a voluntary thing where the dividend is almost implied. So if they're not buying back stock, they're going to have a harder time if they run into any trouble in the business of maintaining that dividend.
Right, they'll have like less wiggle room, I guess, for
yeah, exactly.
And yeah, I see on your fact sheet for some of your DivCon strategy, it talks about Bloomberg fundamentals. Maybe you could talk a little bit about some of the specifics you're looking at, in that regard.
Bloomberg has a dividend health score of their own, and they look at a number of different factors, and then they'll come up with a score between negative 100 and positive 100 on the ability for the company or the likelihood of the company to raise its dividends. Again, I think what we found was, is like dividend estimates, it's helpful in predicting, but it's not the perfect answer. And it's almost like, the ingredients in a cake, where no one ingredient tastes good on its own, but if you combine them all together, you end up with a product or something that's more meaningful and tastes good. And that's really what we found with these 7 factors is each one had its own characteristic, but it wasn't enough. But when you combine them together in a weighting, you end up with a very high probability of success. In fact, going back to 2000, if you were in the top tier, what we call the DivCon leaders or the dividend leaders, you had a 96% chance of increasing your dividend in the next 12 months and never a cut. So there's never been a cut in that category. And you take, say, a strategy like the aristocrats or the achievers, they had almost 20% of the companies cut their dividends in 2008-9. So nearly a fifth of the companies ended up cutting or eliminating their dividend, where the DivCon system never produced a cut.
Wow. Yeah, that's a pretty incredible difference there. So for your DivCon strategy of this 1 to 5 scale, 5 being the best, 1 the worst, do you just focus on companies that have this 5 grade, or do you go down to this 4-3 territory as well?
Yes, we have 3 funds that focus on this model. The one fund that I was just speaking of, the DivCon leaders, only buys the leading dividend growers, so the companies that are in that DivCon 5 bucket. But the index itself is based on a minimum of 30 companies. So if, for example, we had a year where there were just 20 companies that made that top tier score, then it would go down into the DivCon 4 category until it met the 30 company diversification criteria. And then the other 2 funds are based on the premise of, if dividend growers outperform the market and dividend cutters underperform the market, is there a way that we could be long the dividend growers while shorting those dividend cutters and actually end up with a positive return in different market environments? That, if the stock market starts to go down for whatever reason, those lower quality companies most likely to cut are going to generally do worse than the high quality companies that are most likely to grow their dividends. And that's what we found. So Defend, DFND, is the long the DivCon 5 companies, and then it takes a short position in those DivCon 1 companies. And then Guard is just about the same. However, it's going to be dynamic. So during certain market environments, it'll be a long-only position in those high-quality DivCon 5 companies, the dividend growers. And then during other environments, in fact, we're looking at one that could potentially be on the horizon right now. Our Guard indicator is kind of flashing big yellow signals that the market could be at a period where risks are elevated. At that point, it will go to a long and short position. So it'll have a hedge in those companies that are most likely to cut, and it'll be long the companies that are most
Yeah, it certainly has been volatile lately. That's no question about that. I did want to talk briefly more about DFND. So right now, the fund is short some of the sectors you mentioned earlier for energy and utilities. Those are two of the primary ones. And it's long in industrials, consumer staples are some of the biggest ones. I guess I was curious why the 75% 25 split. Why did you choose that? Why not, 80-20 or 50-50? Is there a reason you guys settled on that 75-25?
Yeah, it kind of comes from the philosophy that at the end of the day, these are the 500 largest companies in America, right? Even if you're at the bottom. And not to mention that these are the dividend-paying companies. So they're already fairly robust companies, whether you're at the top of the DIFCON score or the bottom. And if you take the premise that stocks generally go up, which is the case, whether you're good or bad, you don't want to be short, heavily short, during most market environments. And that's where it becomes this idea, okay, so we want to be long more stocks than we are short. But if market corrections occur, is there an appropriate amount of short positions that we can have? And we really didn't want to have any leverage in the fund. So 75 and 25 became kind of that optimal blend, increasing the Sharpe ratio significantly, and then vice versa, also lowering the risk while kind of maintaining a profile that actually outperformed the market for the last 15 years. So it outperformed the S&P, and yet it had almost a third of the volatility or stomach acid from volatility. So that's really how we arrived at that ratio.
So where does this whole DivCon strategy fit in for an investor's portfolio? I know a lot of misconceptions out there about this sort of dividend growth or dividend aristocrat strategy, because a lot of times it's not really a high yield strategy. It's really just more of a high quality strategy. You think that's fair to say?
I think that's a perfect way to explain it, and I think it's such an important distinction right now where, so I guess to answer your question, it really goes in that S&P 500 bucket. So large cap U.S. equity, if you're allocating to large cap U.S. equity, S&P 500 style investments, the dividend growth strategy is probably a better alternative to get that exposure with a better upside and yet, or equal upside to the market and yet lower downside, because again, kind of that's that quality. So when markets do go down, these companies tend to go down less. In fact, the index that the DIFCON leaders is based on has only 80% of the downside when markets go down. In other words, it only goes down about 80% of what the market does. And then as markets go up, it goes up about equal to the market. So it's capturing almost all the upside and yet not all the downside. It's again based on that premise that if the dividends are growing, the earnings are probably growing, it's a stronger business. So it's most of your return is coming from both the dividend, the growth of the dividend, but also the stock and the stock price appreciation.
Definitely. And, I did have a question about one of your other funds that you didn't mention yet, Divvy, D-I-V-Y. So this one seeks exposure to the growth rate of expected dividends. Can you tell us what that means, how that's put into practice?
Yeah, and Divvy is our flagship fund. It was the first fund that we launched and very near and dear to my heart as probably one of the most innovative.
It's your baby, it sounds like.
Yeah, exactly. This is why I started the company. It's based on an institutional strategy where you can capture the growth rate of the dividend without having to expose yourself to the stock market price. And as we all know, stock markets can at times be very emotional and very volatile and have nothing to do with what's happening with the reality of the business or the companies that are in the market. Coca-Cola's stock price might be up or down, and yet there's nothing happening with the earnings. It's just purely based on emotion and expectations. So there's this marketplace where you can capture just the growth rate of the dividend without having to deal with any of the stock market. And it's been traded institutionally amongst either hedge funds or pension funds or banks for years, and we were just the first ones to ever launch it in an ETF structure. So Divvy is investing in these dividend securities that just deliver the growth rate of the S&P 500, or very close to it, and it's really kind of like a bond alternative. So if you think on average dividends grow around 6.5% per year, and you're going to capture some or hopefully most of that with a product like Divvy, and yet you're not going to have all of the volatility. Dividends have only gone down 3 times in 45 years. So you see it's not the sexy upside that you might get with a stock market rally of 30%, but if you're not looking for that, what you're really looking for is the stability, you're getting a much better return than the bond market's going to give you, and yet you don't have any of the interest rate risk associated with that because you're not investing in bonds.
Sure. So what are the actual holdings for Divi? Is it options, futures? How do you actually get this sort of exposure that you're talking about?
So the securities themselves are called dividend swaps, and the way that these work is basically the dividend per share of the S&P 500 is around $45 right now. And we're able to lock that in with an investment bank for 2016, 17, 18, and 19, so the next 3 years. So we're locking in these dividend rates. And as dividends rise above that number, then these swaps become more profitable. They trade up according to the dividend per share of the S&P 500. And then if dividends were to decline, then these dividend swaps would trade down based on that dividend per share. And so it's strictly based on the per share dividend growth of the S&P 500. And then the idea of swaps, that's sometimes kind of a scary word, but really all it is it's an agreement between us and the investment banks, and we only work with the top tier investment banks to where we, face sides with one another, and they're using it as a hedge in case dividends go down. Then we will essentially be paying them, and vice versa. As dividends rise, they'll be paying us. And as we just mentioned, dividends have only gone down 3 times in 45 years. So while it is a hedge for them, it's really an opportunity for us.
Yeah, they're just trying to hedge out this once in a multi-decade situation. Is that fair to say?
Yeah.
Okay.
Yeah, exactly. Kind of the inside baseball behind it is, so banks in general, with their regular course of business, have a very long exposure to dividends. Banks already have a significant amount of exposure to the upside of dividends. And they don't mind if dividends go up because they already have them. So they're able to then, that's kind of like the scraps on the factory floor. They don't need them because they're in the business of creating other vehicles for their clients or hedging instruments and whatnot. So that's why they created this market, was to offset their risk if dividends decline, but also to just unload this off their balance sheet so that they could do more.
Okay. Yeah. I never really knew about this whole dividend swap market, so that's pretty interesting. Is there really anything else from Reality Shares that you can share with us right now about, what's going on the horizon, any new funds, anything like that?
Yeah, so we think of the firm as a whole as these 4 products and then all of the product extensions from that. So you take the DivCon system and you have these now 3 funds, and they're based on the U.S. large cap space. But you could then take that down to the mid cap, the small cap, international, and emerging market, and just kind of take it up and down as well as sideways. Then with Divi, so Divi, we call it isolated dividend growth, where you're the growth rate. So Divi could go to Euro stocks, to the Nikkei, and other major marketplaces in the future. Then if you think about timing of that, really it's more about getting these products up, getting them out, and really focusing on those 4 products, and then later, launching for future products. But I think now is a great time to be looking at the dividend growth instead of the dividend yield. Dividend yield is more overbought. Morgan Stanley just came out with a study. It's more overbought now than it has been since 1975. So the yield play it's just well overdone, and I think it's time to really take some profits in those. And you're already starting to see that in the third quarter, where we saw utilities have gone from the top position in the S&P 500 all the way down to the middle, and they've given up almost half of their returns. That's not what a low-vol stock is supposed to do, and it's just because they got so overbought. So take some profits in your high-yield portfolios, and then think about allocating to dividend growth.
Yeah, it's certainly been a very rough stretch for not just utilities, but REITs, all those high-yield sectors out there. So, might be an interesting time.
Yeah.
Okay, well, great. Thanks for joining us, Eric. I think this is very informative, especially that dividend swap part, and I think the listeners are going to get a lot out of it. So thanks for coming on.
Thank you for having me. It's been great.
All right, everyone, that was Eric Ervin, the CEO of Reality Shares. You can go to his site, realityshares.com, for more information on his ETFs such as Divi or Lead. And you can also go to realitysharesadvisors.com for DivCon scores on stocks too. Well, hope you enjoyed this edition of the Dutram Report, and make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. Until next time, for Zacks.com, I'm Eric Dutram.